Hi class. In this video we're going to look at an example that's very similar to 8-17 in your homework. I tried to figure out the best way to go about this because we're going to have to toggle back and forth. I actually have an ebook, and with the ebook I'm going to have to access some tables that we need electronically. So you just have to bear with me. Yours may look different. If you actually have the paper book, then you're going to have to go into the exhibits that it tells you to go to towards the back of the book, I believe is where yours are. So anyway, this looks like P8-17 says Casey Nelson is a division manager for Pigeon Company. His annual pay raises are largely determined by his division's return on investment, which had been about 23% each of the last 3 years. Casey's considering a capital budgeting project that would require a $5,380,000 investment in equipment with a useful life of 5 years and no salvage value. Pigeon Company's discount rate is 19%, and then we have a table of information that tells us about the net operating income that would be related to the project. So we've got some sales, variable expenses, some fixed expenses. Notice that one of those fixed expenses is depreciation, which is a non-cash expense. That's going to matter later. And we have a net operating income of $724,000. So this is the information that we're going to need to use. As I said, I'm using the ebook, so our exhibits, we're going to click on these links and it will open up a couple of different charts that we're going to have to use. In yours, you're actually going to have to flip to the appropriate page, but we'll look at those in just a bit. As I usually do, I've created a template to do these calculations, and yours can look like this, or you might want to do it a different way. You can do it in Word, however you want to do it. But I think this is the easiest way to kind of show you what I am looking at and how we're going to make these calculations. So the first requirement says, what is the project's net present value? So we're going to use the net present value method to calculate the current value as of this day of what's going to be the value of the cash flows over a period of time. And we're dealing with a 5-year period of time. Let me go back to the book. So we have some information, and we're assuming this is going to be the same for each of the 5 years. It doesn't tell us that there's going to be any variation in that. So for every year for the next 5 years, we're expecting a net operating income in this project of $724,000. So yes, we have an initial cash outflow, but we're also going to have some additional cash inflows over 5 years. So what we're trying to figure out is this a good investment of our money, or can we have a greater return on our money by investing it in something else? And to know that, we're going to calculate the net present value of each of these cash flows. So we minimize that a little bit so we can see both of these. So the way I decided to do it was to calculate the cash flows for each of the 5 years to start with, and then to kind of bring those back to a value of what they would be valued at today. So if we're looking at the purchase of equipment, which is now, today, we would have a cash outflow of $5,380,000. At this point, that's the only cash flow that we're going to have. We're not going to have any other inflows today. We're not going to have any other outflows today. So we're going to just kind of leave the rest of that as it is for the time being. So when we get to year 1, it says that we're going to have sales associated with this, which is a cash inflow of $4,800,000. Oops, is that on the wrong line? So that's going to be a cash inflow. We're going to also have some cash outflows, which would be partly variable expenses, and we get those over here from our chart. So that's $2,160,000. Then we have some out-of-pocket costs. So we look down through our financial information. We have some out-of-pocket costs of $840,000, and that's a cash outflow. And you'll notice at that point I've calculated total cash flows. I didn't include depreciation because we're talking about the time value of money. Depreciation is a non-cash transaction, if you want to call it that, a non-cash recording or valuation entry that we make. So we're going to not include that amount for depreciation in our calculations. So at this point we have total cash flows. Let's see, where's my sum? Total cash flows of $1,800,000, and that's actually a positive number, so that is a cash inflow. So we're going to have the same thing happen for years 2, 3, 4, and 5, so I'm just going to copy those over, save me some time. So every year for 5 years we're going to have a cash flow of $1,800,000, and then at the current point in time we're having a cash outflow. So we're trying to figure out the net present value of all those cash flows. So I'm going to make this a little bigger. So to do that, we're going to have to discount backwards the value of each of these amounts of money, because what they're worth in the future is not what they're worth to us at the present time because of the time value of money. So we're going to apply what we call a discount factor to each of these cash flows. Now each of these cash flows is considered a lump sum payment, and to figure out what the discount factor is, we're going to need to go to one of our charts. So in your book, it's going to say click here, or it's going to say go to such and such page to view, and you have 2 choices of charts. So I'm going to open up these charts so you can look at them. So that is one, and here is the other. So the difference in these charts, the second one I opened was present value of an annuity of $1 in arrears. And you'll see that title right here. And the first one that I opened was a present value of $1. So we're doing the net present value method. And the way I have it set up is in my spreadsheet, I've got 5 amounts that we're looking at, and we're going to take the present value of each of those amounts independently. So when we're talking about an annuity in arrears, we would use the annuity table. We're not going to use the annuity table for this problem. We're going to use the present value of $1, and we're going to apply the discount rate for each of those amounts for every year. So to read this table, we're going to look at the number of periods that a particular amount's going to apply to, and then we're going to look at the percentage rate that we need to look at. So let's see. The percentage rate was given in the instructions. So this says the Pigeon Company's discount rate is 19%. So that's the rate that you're using. So let me go back over here to my chart. So we need to find the 19% column. And for our to discount back each of those amounts, we're going to use the 19% column. The difference is we're going to use a different period, because one of those cash flows is only going to be out 1 year in the future. So we're going to use the period of 1 year and then the 19%. The second cash flow that we're going to have is going to be 2 years out in the future. So we're going to use the second amount that corresponds to the period of 2 years. And then 3 years would be on down, and 4 and 5. So we're going to use each of these amounts and apply those amounts to the amounts in our spreadsheet that show the cash flows for each of those years. So I'm going to try to minimize this, and maybe it's going to be kind of big enough so we can see. And here's my chart. Oops. Here is my chart. So in year 1, we need to find the discount factor that corresponds with 19% in period 1, and that is 0.840. So I'm going to put that in here. In year 2, still at 19%, but going down to the 2-year period, it would be 0.706. Year 3 is 0.53, let's see, 593. 0.593. Year 4, 0.499. And year 5 is 0.419. All right, so let's move this back over a little bit. You'll notice I don't have a discount factor for that $5,380,000 amount. That's actually an amount that we're paying out today. So the discount factor for that is the value of that outflow, because we're doing it right now. So if you want to think of the discount factor of that is times 1, because the value is what it is. There is no discounting back because it's happening at the current time. So the present value of this present cash outflow is $5,380,000. And that's a cash outflow, so I've got it as a negative. The present value of the amount that we'll receive at the end of year 1 is going to be the cash flow times the discount factor. So let's do that. So the current value of that $1,800,000 that we'll receive a year out in the future is actually worth $1,512,000 at this point in time, due to the time value of money. And you should expect that that your cash outflows are going to reduce in value as we bring them back into present value. So I'm going to kind of be lazy and copy my calculation over. So in each of those cases, I've just taken the cash flow and multiplied that by the discount factor. So you can do that. I know in our example, each of these amounts are the same. In a normal business, they're not going to be. You're going to expect some fluctuation, and so these could be 5 different amounts, and it would still work the same. We'd still use that same chart. We would find the value for the percentage, the discount percentage that is given to us in the problem, and then use the period that corresponds with which year we're bringing those back to. So in year 1, you're going to use that period 1, year 2, etc. All right, so after we calculate the present value of each of those 5 amounts, we can calculate the net present value, which is the net present value would be the present value of each of those cash flows totaled together. So we can sum those up, and we have 1 cash outflow and 5 cash inflows, so we can net those out, and we get an actual net present value of $122,600. I'm missing my dollar sign, so it's going to bother me. Let me put those in. So that is actually our net present value, and that was what we were supposed to find in requirement 1. Requirement 2 said, what's the project's internal rate of return? So I've actually put the calculation of how to find that, the formula for calculating that. The factor of the internal rate of return, the first thing we need to do is take the investment required divided by the annual cash inflow. So we have an investment required of $5,380,000. So I'm going to type that out. And that's going to be divided by the annual cash inflow, which is these amounts here, $1,800,000. So this is actually the formula that I used. So if I did that without making it in text so you can see it, would be I have so many zeros it's hard to keep track. I think I've got that right. 2.9888888, and it rounded to 9. So once we get this, then we're going to have to go back into our charts. And let me go back over to those. And this one, instead of using the present value of $1 and bringing those each back to a net present value, I'm actually going to use, mine's labeled Exhibit 8B2. I'm not sure what yours is. It may be labeled the same. But we're going to use this chart. This is the present value of an annuity of $1 in arrears to calculate the internal rate of return. And we can do that because all of those cash flows were kind of equaled out, and they were the same when we calculated this. We used that same amount every year for 5 years. So our internal rate of return, we're going to use this chart. And let's see, we're doing a 5-year period of time. So this is the line that matters to us. But the problem is we don't know the percentage. That's what we're trying to figure out. What's the percentage of the internal rate of return? So we don't know this part, so that's what we're trying to find. So, but we do know the period of time. So we're going to take the 5-year period of time, and we're going to use that percentage that we found. Where did it go? Down here, 2.989 essentially. So let's go back over to our chart. So we can take the 5 and read across till we find something that looks close to 2.989. That's not looking right. Let's see. Oh, yes it is. All right, so our 2.989 is somewhere around in here. There's not a 2.989. There's a 2.991. There's a 2.926. So we look in here, we're kind of in between both of those amounts, but we're closer to 20%. So that's how we figure out what the internal rate of return is. We find that decimal that we calculated by doing the investment required divided by the annual cash inflow. And we just read across and we find a number that is the closest one we can find to that. And that gives us the approximate percentage of our internal rate of return. So when we do that, we're going to take this number. We're going to use the, what do they call that? Present value of an annuity in arrears. Value of annuity. Did I spell that right? Yeah. All right, so we're going to use the present value of annuity in arrears to find the percentage, approximate percentage of the internal rate of return, and we'll find that that is 20%. So there's our 20%. And that is the answer to requirement 2. Scrolling down to requirement 3, the simple rate of return. And again, I've got the simple rate of return is the annual incremental net operating income divided by the initial investment. So that's the formula you're going to use. If we're going to write that out using the numbers that were given, we have an annual incremental net income. We have to go actually back over to our question. Where is it? There it is. That's actually the net operating income that you're given in the instructions. So it's $724,000 is your annual incremental net operating income. So in this case, we're actually considering depreciation in that calculation. So we've got $724,000. And that's going to be divided by the initial investment, which was $5,380,000. All right, so that's the numbers that go into this formula. And if we do that calculation, it would be .134572, or about 13.45%. So let's move the decimal in in to make this a percent. I just changed the format of that. So that's actually what the simple rate of return is. So to do that, you're going to use this formula, plug in your numbers. It's going to give you a decimal. If you want to change that into a percent, you just move the decimal over 2 places, and I rounded it to 1 decimal place. So our approximate simple rate of return is 13.5%. All right, then requirement 4 says, would the company want Casey to pursue the investment opportunity? And would Casey want to pursue the investment opportunity? So we're looking at this question from the company's point of view and Casey's point of view, which is an interesting way to examine this. So when we look up at our net present value, the net present value, we use that method to calculate the value of all these cash flows. It has a net present value of $122,600. That's good. That means that it has a positive cash flow. So in other words, the value of all these cash inflows and the value of the cash outflows is a positive thing. So we're not going in the hole, in other words, over the course of time. So if the net present value is greater than 0, then that just really indicates that the project rate of return is greater than the discount rate, and I think we used 19%. And that's what we want to see. So that looks good in the company's point of view. The other thing the company would look at is that they could look at is their internal rate of return. We calculated internal rate of return of 20%, and if we go back over to the question, it says the company's discount rate of return is 19%. So that internal rate of return is actually greater than the 19%. So again, the company's going to come out good doing this investment. So if I were answering this question, would the company want Casey to pursue this? I would say yes, the company would, because their net present value is greater than 0. And their internal rate of return is greater than their discount rate. That's my reason for doing that. So you kind of think along the lines of that logic when you look at your example, because yours may be something different. It may say that there's a negative in the net present value, and maybe their internal rate of return is only 10% and their discount rate is 19%. So in that case, the company is going to say, no, let's not do that. We can better invest this money in another way. But this is my answer, given my scenario, and that's the reason why I'm saying that. So the second part of that question says, would Casey be inclined to pursue this investment opportunity? And that's interesting, because we're going to look back at the instructions to this problem. It says Casey Nelson is a division manager for a pigeon company, and his annual pay raises are largely determined by his division's return on investment. So if you think about that, I remember return on investment, we've looked at it in the past, is just the gain on an investment minus the cost of an investment. So basically, kind of what you've cleared on the investment divided by the cost of investment. So that's what his annual pay raises are based on, is a calculation that's based on return on investment. So that if we look at this as an investment, does it give us the return on investment? Yeah. Their return on investment has generally been about 23%. If we look at the simple rate of return, and that's what we would be looking at in his mind, because that's the simple rate of return is the calculation that is going to most compare to or most help us to figure out what the impact is going to be on the return of investment overall for the company. So it says the division's return on investment is 23%. And our simple rate of return that we calculated was 13.5%. So if we think about look at this calculation, the annual incremental net operating income, that sounds a whole lot like the top of that return on investment calculation, gain on investment less the cost of investment. So that's really what we're looking at here, and then dividing that by the initial investment. Return on investment calculation is the bottom, the denominator of that is cost of investment, so kind of the same calculation. So if we were looking at this 13.5% and thinking, what impact is that going to have on the return on investment, because Casey cares about that return on investment amount. And the company's return on investment is 23%, and if he throws this into that mix and it's only a 13.5% return on investment, that's going to bring the overall average of that return on investment down, which means it's going to negatively affect his pay raise. So when we look at this question, would Casey be inclined to pursue this investment opportunity? And this is from his personal point of view. I would say no, and that is because the simple rate of return that we calculated at 13.5% is less than the company's return on investment, which was 23%. So it's going to bring down that return on investment average, which is going to negatively affect him. So we could argue the ethics of that. Certainly, if he's making decisions that are in the best interest of the company, then that shouldn't matter. But if we're looking at this, and the question says, would he be inclined? So he might have some hesitation about doing that for personal reasons. So for personal reasons, no, he would not want to do that. And just kind of on a side note, this isn't part of the question, but that is a really good reason to think about as a manager of a company how we structure pay structure and compensation and what we tie it to, and who we give decision-making authority over things that are tied to their pay. Because if they have decision-making authority over things that directly associate with their pay, they could be inclined to make some decisions in their personal interest and not in the company interest. So that's just an internal control issue that you'd want to look at as a leader. If you have bonus structures or pay raise structures that are tied to something that an individual is responsible for controlling. So that's just my side note, just things to think about. So hopefully this will help you. Again, your calculations can use this format. They may come out to be negative, which would change some of your answers, but you should still be able to use the chart that I use, the same exhibits in the textbook that I use, and these calculations that I've given you here to use to calculate your answers. The main thing that may be different with yours is requirement 4, because it depends on what percentage you come up with. But look at my answers, and that should kind of help you think through yours. I hope this was helpful. If you have any questions, as always, feel free to contact me.